You've probably heard it your whole life, right? Buying a home is the single best investment you'll ever make. It's the cornerstone of the American dream. But what if that cornerstone is actually a millstone, dragging your finances down? Yeah, let's dive into that controversial idea. And boom, there it is. A direct quote from Robert Kiyosaki, the author of that mega bestseller, Rich Dad, Poor Dad. Now, for most people, that statement is just financial heresy. It's crazy, right? He's claiming the one thing everyone has told you is your greatest asset is actually your biggest liability.
So that really is the big question, isn't it? How can a $500,000 property, something you can literally see and touch, be making you poor? Well, the answer isn't in what you've always been told. It's in the cold, hard math, the kind of math the financial system might prefer you didn't look at too closely.
Today, we're putting all that conventional wisdom under a microscope. We're going to give you a whole new framework to think about your financial future. So if you're ready to stop following the crowd and start following the cash flow, let's get into the one definition that could totally change your financial life.
It all starts with something really simple, but incredibly powerful. Let's just call it the cash flow test. Think of it like a litmus test for your money. It instantly tells you if something is making you richer or if it's making you poorer. The simplicity here is kind of deceptive. I mean, in traditional accounting, an asset is just something you own that has value. But for actually building wealth, this definition is the only one that matters. Does it put money in your pocket or does it take money out of your pocket? Your primary home doesn't pay you, you pay for it, constantly.
And this, right here, illustrates the two sides of the coin perfectly. Every single month, you send that mortgage payment to the bank. That money is flowing out of your pocket, which makes the house your liability. But what about the bank? Well, your payment is their income. It's cash flowing into their pocket, making your mortgage their asset. You're literally building someone else's asset column every month.
Okay, so now that we've got the framework down, let's apply it. We're going to put a pretty typical $500,000 home under the microscope and really reveal those hidden costs that people just conveniently forget to mention.
To make this super real, let's use a specific example. Picture a $500,000 home, and we're not even going to look at the whole 30-year mortgage, just the first 15 years. We're going to focus on what are called sink costs, and that's exactly what it sounds like. Money you pour into the house that you will never, ever see again.
Okay, you might want to sit down for this number. Over those 15 years, the total sink costs will be over $450,000. That is almost the entire original price of the house, just gone. Let's break down where it all goes.
So just look at this breakdown. The biggest wealth killer right here is mortgage interest. You're paying the bank nearly $300,000. Then you've got property taxes, another $94,000 to the government. And finally, using the standard 1% rule for maintenance because, things are going to break, that's another $75,000 out of your pocket. It all adds up to that staggering $459,000.
Seriously, let that sink in for a second. This isn't your equity. This isn't an investment. This is just the price of admission for owning that home. Nearly $500,000 that could have been out there working for you is instead gone, forever, paid to banks, governments, and contractors.
But believe it or not, even that huge number isn't the biggest cost. The most significant expense is the one that's completely invisible, and it's probably your biggest financial blind spot: opportunity cost.
Think about your down payment for a second. Let's say it's $100,000. When you put that into your own home, that money is, well, it's effectively dead. It's just locked up in the walls, and it actually creates a monthly cost for you. But what if you put that same $100,000 into a real asset, like a rental property? Suddenly, that money is alive. It's working for you 24/7, generating cash flow and creating a monthly income.
So, does all this mean that property is always a bad deal? No, not at all. It just means you have to change your strategy. Let's look at how you can take this exact same idea, owning property, and flip it from a liability into a true wealth-building asset.
This strategy is often called house hacking. So instead of a single-family home, you buy a multi-unit property, like a duplex or maybe a fourplex. You live in one of the units and you rent out the others. Now, if the rent you collect from your tenants covers the entire mortgage, the taxes, the insurance, and maybe even leaves you with a little profit, you've done it. You have successfully turned your biggest monthly expense into an income-producing asset.
This right here is the bottom line. It's the one rule you just have to remember. It doesn't matter what the market is doing, it doesn't matter what your real estate agent tells you. If the property is not putting more cash into your pocket each month than it takes out, it is a liability, period. End of story.
So what's the big takeaway from all of this? Well, it's really about understanding the difference between a lifestyle choice and a financial choice, and just being honest with yourself about which one you're actually making. Hey, if you want stability and a sense of community and the freedom to paint the walls whatever color you want, that is fantastic. You should absolutely buy a house for those reasons. But don't trick yourself into thinking it's a guaranteed path to wealth. The numbers we just went through prove that's a really dangerous assumption.
So here's the final piece of strategic advice. Focus on building your asset column first. Buy things that generate income. We're talking rental properties, dividend stocks, maybe businesses. Let those assets grow until they produce enough cash flow to buy that dream home for you. Now that is how you win the game.
Ultimately, this isn't about telling you not to buy a house. Not at all. It's about urging you to actually look at the numbers so you can make an informed decision. The data is clear, the calculations are straightforward, the math doesn't lie. The only real question is, are you listening?